Hello class. In this video we're going to learn a little bit about diluted earnings per share, and in particular we're going to look at the effect of stock options when it comes to diluted earnings per share. So just to have a little context here, we already have basic earnings per share, which is equal to net income, subtract out preferred dividends if applicable, and divide all of that by the weighted average number of shares, common shares outstanding. And so with diluted, what we're looking at is if some of these other items were converted, what would happen with our earnings per share? For example, imagine you have 1,000 common shares outstanding, but you have 1,000,000 shares in potential stock options out there. If all those stock options get converted, what's going to happen? We're going to have a much lower earnings per share. So that's information that our stockholders really want to know, is not only how did we do on the basic, but if everybody converts, where will we be in the future? So we're going to use the information provided in this example and walk through it and learn a little bit as we go. So with this, we have some information provided for us. We have 340,000 employee options, and note that they were granted on October the 1st of the current year. We're going to have to make a little adjustment at the end of this problem to deal with that partial year issue. Next, a little bit different here. Each option gives the holder the right to buy 2 shares of stock. And we have the exercise price of 18. And notice the average market price of the common shares during the year for this company was $20. Basically, there's a little shortcut here, is that as long as the average market price is higher than the exercise price, then we're always going to have a dilutive effect on our earnings per share. So that we're always going to have to figure out what would the denominator increase by if everybody converted. So the method we're using here is called the if converted method. And so we're just going to walk through it. So first, what we want to do is find out the total amount of proceeds the company would receive if all the employees exercised. So we have 340,000, multiply that by 2 shares per option, multiply that by the exercise price of $18 per share. The company would have hypothetical proceeds of $12,240,000. Our next piece of this puzzle is that we assume that the company is going to take all those proceeds, and throughout the year they're buying back stock. So they're issuing the stock with the options, buying it back, pretend. And so we use the average market price. So we take the total proceeds, the 12 million number, and we divide that by $20. And what that does is that we could come out to 612,000 shares. And so if we issued all these stock options, remember there were 340,000, 2 shares per option. So how many shares would we have issued? 340 times 2 will give us 680,000 shares. With our hypothetical proceeds, we bought back 612,000 shares. So the incremental number of shares is simply subtracting you take 680 and then subtract out the 612,000, and you'll get 68,000 shares. That's incremental shares. The last little twist here is that this only happened in October. Because of that, we do a partial part of the year, just like we do with the weighted average common shares outstanding, and we simply take the $68,000, multiply that by 3/12, October, November, December, 3 months out of the year, and that'll give us our answer of 17,000.